Welcome to a region experiencing some of the harshest real estate corrections in the country, where communities that boomed during the pandemic are now watching property values slide at an alarming pace. In this countdown, we're exploring the 10 cities being hit hardest by the downturn. Our journey will take us across the rugged landscapes of Idaho, through Oregon's rain-soaked valleys, and into the technology-driven centers of Washington. Along the way, we'll uncover places where soaring home prices once seemed unstoppable, but are now falling back to earth in dramatic fashion. It is difficult not to sympathize with ordinary families caught in the middle of all this. Many simply hope to achieve their version of the Pacific Northwest dream, buying homes surrounded by forests, mountains, and natural beauty. Instead, some now find themselves holding properties that continue to lose value while financial uncertainty grows around them. Before we head out on this rainy journey and watch these markets unravel city by city, take a moment to subscribe to the channel, leave a like, and share any real estate stories from your own area in the comments below. Your support helps make these deep dives and road trips possible. Number 10. Spokane, Washington. As our journey reaches eastern Washington, the first thing that stands out is the beauty of the Spokane River. Not far behind, however, is the stark reality of a housing market that appears to be dealing with the aftermath of a massive boom. Only a few years ago, Spokane became a magnet for buyers escaping the soaring costs and crowded living conditions of Seattle. At the time, it seemed like the perfect alternative. Today, that optimism has faded considerably. Picture purchasing a home believing it was a secure, long-term investment, only to discover that local home values have been steadily moving in the opposite direction. Recent market data indicates that median home prices have fallen by roughly 8% compared to a year ago. For many homeowners, that translates into tens of thousands of dollars in lost equity seemingly evaporating overnight. A drive through neighborhoods such as South Hill tells part of the story. For sale signs remain planted in front yards week after week, lingering far longer than they did during the frenzy of the pandemic years. Housing inventory has surged dramatically, rising more than 40% from the same period last year. Sellers who once expected bidding wars now find themselves wondering where all the eager out-of-town buyers disappeared to. The answer is fairly simple. Some have returned to larger cities as employers call workers back to the office, while others have shifted their attention to less expensive markets. Either way, demand is no longer overwhelming supply the way it once did. The situation is especially frustrating for local residents who patiently waited for prices to come down. Even though home values have softened, affordability remains a major challenge. Monthly mortgage payments are still extremely high because elevated interest rates continue to offset much of the benefit from lower purchase prices. For many households, owning a home remains just as difficult as it was during the peak of the boom. Meanwhile, investors and house flippers are feeling increasing pressure. A significant share of active listings have already undergone at least one price reduction, a clear sign that sellers are adjusting to a much different market environment. Properties that once attracted offers within days are now spending more than 2 months on the market before serious buyers even begin to show interest. Adding to the strain, reports indicate a noticeable increase in mortgage delinquencies as homeowners struggle to keep up with rising financial obligations. Many families are finding themselves squeezed from every direction. Falling home values reduce equity. Property tax assessments based on peak-era valuations remain expensive, and higher borrowing costs continue to discourage new buyers from entering the market. Number 9. Bend, Oregon. Continuing south through Oregon's high desert, you arrive in a city known for its craft beer scene, world-class skiing, and outdoor lifestyle. During the pandemic, Bend became one of the country's hottest destinations for remote workers, especially well-paid tech employees searching for more space and scenery. Now that boom is losing momentum, and the mood has shifted dramatically. Recent market data shows that median home sale prices have dropped by about 9% compared to a year ago. For homeowners who bought near the peak, that decline represents a substantial loss in value. What once seemed like an unstoppable market is beginning to look much more uncertain. The change becomes even more noticeable in the newer developments around town. Housing inventory has surged, rising roughly 55% from the same period last year. Homes that once attracted intense competition are now sitting unsold for much longer. Many buyers who moved here during the remote work craze are reconsidering their options as employers push workers back toward major metropolitan areas. Longtime residents face a different challenge. Bend's median household income remains far below the price level of its housing market. With typical home prices still hovering above $700,000, affordability has become a major concern for the people who work in the city's tourism, hospitality, and service industries. The gap between local wages and home values has become increasingly difficult to ignore. Investors are feeling pressure as well. The short-term rental market, which helped fuel much of Bend's growth, has cooled considerably. Occupancy rates for vacation rentals have fallen significantly over the past year, turning many properties that once generated strong cash flow into far less profitable investments. The slowdown is affecting nearly every segment of the market. Homes are now spending around 80 days on the market on average, and even the luxury sector has weakened sharply, with high-end sales dropping by roughly 30%. Sellers who expected bidding wars are increasingly cutting prices in an effort to attract buyers. Bend's rapid rise and equally rapid cooling illustrate how quickly a market driven by remote work demand can change. A city that was celebrated as a dream destination for lifestyle-focused buyers is now becoming a reminder that housing booms, fueled by extraordinary circumstances, can reverse just as quickly as they begin. Number 8. Tacoma, Washington. Making our way back north along Interstate 5, we arrive in Tacoma, a city long viewed as Seattle's more affordable and blue-collar counterpart. During the height of the housing frenzy, thousands of buyers looked south in search of lower prices, convinced they had found a smarter and more affordable alternative. Today, that confidence is being put to the test as the market cools and home values begin to retreat. Recent housing figures show that median home prices in Tacoma have fallen by approximately 7% over the past year. For homeowners who purchased during the peak of the market, that decline represents a significant loss of equity. What once looked like a bargain compared to Seattle is becoming a far less comfortable investment. A drive through neighborhoods such as the historic North End reveals just how much conditions have changed. The fast-paced activity that defined the market only a few years ago has largely disappeared. Homes are no longer attracting crowds of eager buyers, and the sense of urgency that once dominated open houses has faded. Market analysts report that more than 60% of homes are now selling below their original asking prices. That statistic highlights a dramatic shift in negotiating power. Buyers who remain in the market have become much more selective, while elevated mortgage rates continue to discourage many others from purchasing altogether. For sellers, the adjustment has been difficult. Many are still holding on to expectations formed during the extraordinary conditions of the pandemic boom, when bidding wars and above-asking price offers were common. Today's reality looks very different. The slowdown is also visible in the amount of time properties spend on the market. Homes now sit available for roughly 50 days before finding a buyer, a sharp contrast to the rapid sales that became normal during the peak years. What once felt instantaneous now requires patience and significant price flexibility. More concerning are signs of growing financial strain beneath the surface. Reports indicate that foreclosure activity in Pierce County has been trending upward in recent quarters, suggesting that some homeowners are struggling under the weight of large mortgages taken on during the market's most competitive period. For families who purchased with minimal margin for error, rising costs and declining values can create serious challenges. The rental sector is feeling pressure as well. Average rents have softened, reducing income for property owners who counted on strong rental demand to support their investments. Landlords who expected steady cash flow are finding the environment increasingly difficult. Despite recent price declines, the typical home in Tacoma still carries a price tag of around $500,000. For many local residents, that figure remains difficult to reconcile with area incomes and overall affordability. The result is a market caught between falling demand and prices that many buyers still consider out of reach. Number 7. Eugene, Oregon. Continuing our journey through Oregon's Willamette Valley, we arrive in Eugene, a city known for its deep connection to track and field, the presence of a major university, and a relaxed culture that has long attracted students, artists, and outdoor enthusiasts. Yet beneath that easygoing reputation, the local housing market is dealing with a much harsher reality. For homeowners hoping to sell, conditions have become noticeably more challenging. Recent housing data shows that median home prices have declined by roughly 6% compared to a year ago. While that may not sound dramatic at first glance, it represents a meaningful loss of equity for many people who purchased during the market's peak. A drive through neighborhoods surrounding the university highlights how quickly the landscape has changed. Properties that once attracted immediate attention are now competing against a growing number of listings. Housing inventory has expanded significantly, with active listings climbing nearly 50% from the previous year. Sellers who expected strong demand are finding themselves in a much more crowded market. The increase in available homes has created intense competition among property owners. Many are being forced to lower their asking prices in order to attract buyers. Market reports indicate that more than a third of current listings have already undergone substantial price reductions, signaling that sellers are becoming increasingly motivated to make deals. Investors who entered the market expecting endless appreciation are feeling the pressure as well. Many purchased starter homes during the boom years, anticipating strong returns, only to discover that demand is no longer keeping pace with supply. As conditions soften, some are rushing to exit their positions before prices decline further. The slowdown is not limited to existing homes. New construction activity has weakened considerably, with permits for single-family housing falling sharply. Developers appear far less eager to launch new projects, reflecting growing concerns about future demand and market stability. Rental property owners are facing challenges of their own. Reports suggest that student housing vacancies have increased, creating additional pressure on landlords who counted on consistently strong occupancy rates. Some investors who built their business models around ever-rising rents are discovering that reality does not always cooperate with expectations. Number 6. Coeur d'Alene, Idaho. As we head east into Idaho's scenic panhandle, we arrive in Coeur d'Alene, a picturesque lakeside community that became one of the most dramatic examples of the pandemic housing boom. Surrounded by sparkling water, dense forests, and mountain views, the town attracted a wave of newcomers seeking a quieter lifestyle. Buyers arrived from larger and more expensive states, bringing strong purchasing power that quickly transformed the local housing market. Today, however, the story looks very different. The migration surge that fueled years of rapid price growth has slowed significantly, and the market is now experiencing a painful correction. Recent local housing data shows that median home prices have fallen by approximately 12% from a year ago, creating challenges for homeowners who purchased near the peak. Driving along the shoreline and through upscale neighborhoods, it becomes clear that the luxury segment has been hit especially hard. High-end properties that once drew intense interest from wealthy buyers are now sitting on the market much longer. Sales of luxury homes have dropped sharply, reflecting a noticeable decline in demand from second home buyers and remote workers who once viewed the area as an ideal retreat. Many owners who purchased vacation properties during the frenzy are now attempting to sell, contributing to a growing inventory of available homes. Reports indicate that nearly half of current listings have undergone price reductions, a sign that sellers are adjusting expectations in response to weaker buyer activity. The balance of power has shifted decisively. Housing supply has expanded to levels that strongly favor buyers, creating a market environment that would have been difficult to imagine during the height of the boom. Sellers who once enjoyed multiple offers are now facing longer wait times and greater pressure to negotiate. What makes the situation particularly striking is the continued affordability gap. While local household incomes remain relatively modest, home prices are still extraordinarily high by comparison. The median household income sits around $55,000, yet typical home values continue to hover above $600,000. For many residents, that disconnect makes homeownership feel increasingly out of reach. Teachers, healthcare workers, service employees, and other longtime residents have faced years of rising housing costs that far outpaced local wages. As prices surged during the migration wave, many found themselves competing against buyers arriving with significantly larger budgets and greater financial resources. Number 5. Bellingham, Washington. As we continue north toward the Canadian border, we arrive in Bellingham, a stunning coastal city where mountain landscapes blend seamlessly with the waters of the bay. For years, this community was viewed as a quieter, more relaxed alternative to the fast pace of Seattle. During the pandemic housing boom, however, that reputation attracted a flood of buyers, and home prices climbed to levels many locals never imagined possible. Now the market is beginning to move in the opposite direction. Recent housing figures indicate that median home values have declined by roughly 5% over the past year. While that correction may seem modest compared to some other cities on this list, it still represents a significant financial setback for homeowners who purchased near the peak of the frenzy. A stroll through downtown Bellingham or the historic Fairhaven district reveals a noticeably different atmosphere than just a few years ago. The intense competition that once defined the local market has faded, replaced by a slower pace and a growing number of available properties. Housing inventory has risen sharply, with active listings increasing by nearly 40% compared to the previous year. The shift is becoming increasingly visible. Homes that once sold almost immediately are now remaining on the market for far longer. On average, properties are spending around 50 days waiting for buyers, a dramatic change from the rapid transactions that characterized the boom years. Sellers who expected multiple offers are often finding themselves adjusting prices or offering incentives simply to attract interest. Higher borrowing costs have become one of the biggest obstacles facing the market. Mortgage activity has fallen substantially as elevated interest rates make homeownership more expensive and reduce purchasing power for prospective buyers. Many households that could have qualified for a mortgage just a few years ago now find themselves priced out of the market entirely. The challenges extend beyond home sales. The rental market, once considered a reliable source of demand, is also showing signs of weakening. Vacancy rates have increased, creating additional pressure for landlords who purchased investment properties at peak valuations and expected strong rental income to offset rising costs. For local residents, the affordability issue remains particularly frustrating. Young families, recent graduates, and longtime community members increasingly struggle to find housing that fits within their budgets. Even with prices softening, the gap between local incomes and housing costs remains substantial. Many people who grew up in the region now face difficult decisions about whether they can afford to stay. The rapid appreciation of recent years transformed what was once a relatively accessible coastal city into a market that became increasingly difficult for average residents to navigate. Number 4. Portland, Oregon. As we head south into Portland, the atmosphere feels very different from the city that once captured the imagination of home buyers across the country. For years, Portland was celebrated for its unique culture, vibrant neighborhoods, thriving food scene, and reputation as one of the Pacific Northwest's most desirable places to live. Today, however, the housing market is facing significant challenges as shifting economic conditions and changing migration patterns reshape the city. For homeowners, the adjustment has been painful. Recent housing reports indicate that median home prices have fallen by approximately 8% over the past year. For many residents who purchased during the height of the market, that decline represents a substantial reduction in home equity and a growing sense of uncertainty about future values. A closer look at the city center reveals some of the most dramatic changes. The condominium market has been particularly affected, with downtown condo values experiencing steep declines. As remote work became more common and many professionals reconsidered urban living, demand for central city housing weakened considerably. Buildings that once attracted intense buyer interest are now facing a much more competitive environment. Market analysts report that overall buyer demand has fallen significantly compared to just a few years ago. At the same time, population shifts have contributed to a growing supply of available housing. As some residents relocate to suburban communities or leave the region altogether, more homes are entering the market while fewer buyers remain ready to purchase them. That imbalance is becoming increasingly visible across the metropolitan area. Active housing inventory has risen sharply, giving buyers more options and reducing the urgency that once fueled bidding wars. Properties that previously would have sold within days are now spending weeks or even months waiting for offers. The longer selling times have created additional frustration for homeowners hoping to move. Many sellers are discovering that pricing strategies that worked during the boom years no longer generate the same level of interest. Homes are remaining on the market for extended periods, forcing owners to adjust expectations and, in many cases, lower their asking prices. Longtime residents face a particularly difficult situation. Many have remained committed to their neighborhoods through years of change, only to watch home values decline while ownership costs continue to rise. Property taxes and other housing-related expenses remain significant concerns for households already coping with broader economic pressures. The investment side of the market is also showing signs of strain. Some property owners report that rising costs, increased regulations, and reduced profitability are making residential real estate less attractive than it once appeared. As a result, more landlords are considering selling their properties rather than continuing to operate them as rentals. Number 3. Vancouver, Washington. A short drive across the Columbia River brings us to Vancouver, a city that spent years benefiting from its unique position next to Portland. For many buyers, it seemed like the perfect solution. Residents could enjoy Washington's lack of a state income tax while still maintaining access to Portland's job market and urban amenities. During the housing boom, that formula attracted a flood of newcomers and helped drive home prices sharply higher. But like many markets across the Pacific Northwest, Vancouver is now facing a difficult reality. Recent housing data shows that median home prices throughout Clark County have declined by roughly 7% over the past year. For homeowners who purchased near the peak, that drop represents a significant loss of equity and a reminder that even seemingly safe markets are not immune to corrections. Driving through the rapidly expanding suburban neighborhoods on the outskirts of the city, signs of a slowdown are hard to miss. Construction activity has cooled considerably, and new development projects are no longer moving at the pace they once did. Recent figures indicate that residential building permits have fallen substantially, suggesting that developers are becoming much more cautious about future demand. The shift is largely tied to changing buyer behavior. During the height of the boom, out-of-state buyers and remote workers helped fuel extraordinary demand. Today, many of those buyers have disappeared from the market, leaving sellers to compete for a much smaller pool of qualified purchasers. The increase in available homes has been dramatic. Housing inventory has surged, giving buyers more choices and reducing the urgency that once fueled bidding wars. Neighborhoods filled with recently built homes now contain far more for sale signs than they did just a few years ago. As competition intensifies, sellers are increasingly lowering their asking prices. Market reports show that roughly one-third of active listings have already undergone price reductions. Many homeowners are adjusting expectations as they discover that strategies that worked during the boom years are no longer producing results. At the same time, affordability continues to worsen despite falling prices. Higher mortgage rates have dramatically increased borrowing costs, making monthly payments far more expensive than they were only a few years ago. Even buyers who could technically afford a home at today's prices often struggle with the financing costs attached to those purchases. Number 2. Boise, Idaho. Heading deep into Idaho's Treasure Valley, we reach what has become one of the most extreme examples of the recent real estate boom and its aftermath in the United States. During the pandemic, Boise was widely seen as a dream destination for remote workers, drawing in an enormous wave of new residents and pushing housing prices to levels that many longtime locals struggled to understand. Today, that surge has reversed with force. Market data from Boise area realtors shows that home prices have dropped by roughly 15% from their peak. For anyone who bought during the height of the frenzy, that represents a steep and painful correction in a very short period of time. The underlying cause is fairly straightforward. A sudden influx of remote workers temporarily inflated demand far beyond what the local economy could sustainably support. But as companies began requiring employees to return to offices, much of that demand disappeared almost overnight, leaving the market significantly overheated in reverse. Driving through newly built subdivisions on the outskirts of the city, the slowdown is easy to see. Rows of recently constructed homes now sit in quiet neighborhoods with far fewer buyers actively competing for them. The urgency that once defined the market has largely faded. Recent reports show just how much conditions have changed. More than half of all active listings have undergone price reductions, a clear sign that sellers are struggling to meet the expectations they set during the boom. Many homeowners who purchased at peak prices are now finding themselves in a difficult position as equity levels decline and buyer interest weakens. Inventory levels have also surged to historically high levels for the area. With roughly 7 months of housing supply on the market, Boise has shifted firmly into buyer-friendly territory. The intense competition that once drove bidding wars and rapid sales has been replaced by hesitation and longer decision-making cycles. Investor activity has pulled back sharply as well. Major institutional buyers and short-term rental investors have significantly reduced their presence in the market, recognizing that the rapid appreciation they once relied on is no longer guaranteed. That retreat has further reduced demand, adding to the overall cooling effect. Homes are now taking much longer to sell, with many properties sitting on the market for more than 2 months before receiving serious offers. This is a stark contrast to the fast-paced environment of just a few years ago, when multiple offers and above-asking price sales were common. Number 1. Seattle, Washington. We circle back to the damp, familiar coastline of Puget Sound and arrive at the largest and most influential market in the Pacific Northwest downturn. Seattle, long powered by the engine of big tech, high salaries, and stock-based wealth, is now facing a noticeable shift in momentum as that same engine begins to slow. For homeowners, the change is impossible to ignore. Recent data from regional listing services shows that median home values have fallen by about 10% year over year. On a $1 million property, that kind of decline represents a serious loss of equity, especially for buyers who entered the market near its peak. As you move through Seattle's hillside neighborhoods and dense tech corridors, the cooling conditions become increasingly visible. The wave of layoffs across the tech industry has significantly weakened demand, removing a large portion of the high-income buyers who once drove intense competition for housing. Market analysts have noted a sharp decline in buyer activity at the higher end of the market, with demand dropping by roughly 30% compared to previous years. At the same time, uncertainty around job stability has made many potential buyers hesitant to commit to large mortgages in a falling market. Inventory has expanded rapidly. Reports indicate that active listings across the metro area have surged by around 50% as more homeowners attempt to sell while fewer qualified buyers are stepping in to absorb the supply. The result is a market that feels increasingly heavy and imbalanced. Even the luxury segments in downtown Seattle have not been spared. Prices in certain high-end urban areas have declined, and foot traffic in some commercial districts remains weaker than in the past, contributing to a broader sense of slowdown in the city core. The financial stress is beginning to show in more concerning ways as well. Mortgage delinquency rates across the metro area have increased, suggesting that some households, despite high incomes on paper, are struggling to keep up with rising costs and adjusted property values. What once felt like stable, high-growth wealth is proving more fragile under changing conditions. Homes are also taking much longer to sell than they did during the boom years. Instead of moving within days or even hours, properties are now sitting on the market for nearly 2 months on average. For a city that was once defined by ultra-fast transactions and intense bidding wars, this represents a major shift in market behavior. For many working families and middle-income residents, the situation remains complicated. Even with price declines, affordability is still constrained by elevated interest rates and the overall cost of living. Some households that hoped for a long-awaited cooling of the market are finding that lower prices alone are not enough to restore accessibility.